Welcome to the NFO review series. I'm Rin Agarwal. In this video, I'm going to be reviewing the Mirae Asset Corporate Bond Fund. First off, what is a corporate bond fund? Well, it's a fund that invests at least 80% in bonds that are rated AA plus and above. So basically, high quality corporate bonds. And the balance 20% can be in other bonds, and also they can have exposure in REITs as well. Now, corporate bond funds come with various advantages. They do have high safety, and that's because a higher exposure is to bonds which have very high rating. They are liquid, and at the same time, they have the potential of good returns as well. So, should you invest? No, I think that investing in a corporate bond fund is like choosing a thematic fund because you're exposing yourself only to one type of bond. And I have always maintained that in the debt space, if your investment horizon is above 3 years, then look at short term debt funds. The reason being that in short term debt funds, the fund manager can look at investing into corporate bonds as well as government securities. If we compare the expense ratios as well between corporate bond fund and between the short-term debt funds, you would find that in the direct plan, the expense ratios are between 0.25 to 0.4%, and they're quite similar. At the same time, the modified duration also in these funds is pretty similar. So short-term debt funds need to have a Macaulay duration of between 1 to 3 years, whereas in the corporate bond fund, the typical duration would be in the range of 2 to 5 years. When I look at the current fact sheets, I find that in most cases, the duration is between 1.5 to 2 years, whether it's a short-term debt fund or a corporate bond fund. So essentially, the modified duration as well as the expense ratio is similar in both these funds. But what is very different is the standard deviation. As you can see, the rolling returns over a long-term basis also seem to be very similar. But look at the standard deviation difference between a short-term debt fund and a corporate bond fund. Corporate bond funds have had much higher volatility. And what does this mean? It really means that with higher volatility, the chances of people remaining invested is actually much lower. So from a risk-adjusted returns basis, short-term debt funds work out much better as compared to corporate bond funds. My take, I would not recommend investing in this fund. There are many existing funds from other fund houses that have got performance data over many years to show you as well. In any case, my suggestion is to go in for a short duration debt fund. Of course, when you look at short duration debt funds, do check out the credit quality of the portfolio and do go in for funds with high credit quality. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye-bye.